If everybody's on one side of the boat, you usually don't want to be there. Today, I'm going to walk through why the S&P 500 may be putting in a multi-year top right now, using three simple charts: price, positioning, and leverage. Here's the SPY, the ETF that tracks the S&P 500. Notice the steep rising channel airs wedge that started from the spring lows. Each rally gets narrower, momentum is slowing, and price is grinding along the upper trend line. Now look at what's happening right now. Price has broken below that rising trend line. It's also starting to lose key moving averages that supported the entire advance. This is classic topping behavior, a final melt-up followed by a break of support. That doesn't guarantee a crash tomorrow, but it does tell us the character of the market has changed from every dip gets bought to rallies are being sold. Now let's look at positioning. This chart shows short interest as a percentage of shares outstanding for SPY and QQQ. Over the last several years, you can see spikes during periods of fear and corrections, but follow the trend to the right side of the chart. Short interest has collapsed to the lowest levels in roughly 8 years. What does that mean? There are almost no shorts left to cover. Shorts are future buyers. When they're squeezed, they push markets higher. With short interest this low, the market has very little shock absorber on the downside. If prices fall, we don't get a powerful short squeeze. We just get long selling to other longs, and eventually no one left to buy. That's exactly the kind of positioning you see near major tops, not at the beginning of new bull markets. Now layer on retail behavior. At the top, we see options contracts traded on Robinhood. In October, options volume jumped 22% in a single month. That's nearly 70% year-over-year growth, a surge in pure speculation. At the bottom, we see the margin book. Margin debt has exploded to about $16.5 billion. That's a 19% increase in 1 month and about 166% higher year-over-year. Translation: retail investors are all in, heavily leveraged, and using options to chase upside. Cash balances are thin, and there is very little dry powder left. In that environment, a normal 5 to 10% pullback doesn't get bought aggressively. Instead, it turns into a deleveraging event. Margin calls, forced selling, and a buyer's strike from investors who are already fully committed. So what do we have? Price. SPY has formed a rising wedge and is now breaking support. Positioning. Short interest in SPY and QQQ is at an 8-year low. There are basically no bears left to squeeze. Leverage. Retail investors are maxed out on margin, with options speculation exploding and very little cash on the sidelines. That combination, extended price, crowded longs, no shorts, and peak leverage, is how multi-year tops are born. It doesn't tell us the exact day the top is in, but it strongly suggests that the next big move is more likely to be down or sideways for years rather than another smooth leg higher. This isn't a call to panic, and it's not personalized advice, but it is a reminder that when everyone is on the same side of the trade, long, leveraged, and complacent, that's usually when the risk is highest. If you found this helpful, hit like, subscribe, and drop a comment. Do you think this is a multi-year top in the S&P 500 or just another buy the dip moment?